In 1950, a 19-year-old kid walked into a bookstore and bought a book for $3. That book eventually helped him make over $100 billion. The kid was Warren Buffett. The book was The Intelligent Investor by Benjamin Graham. Now here's what's interesting. Graham almost didn't include Chapter 8 in this book. His publisher thought it was too abstract, too philosophical. But that single chapter contains what Buffett calls the most important investment advice ever written. I'm going to explain this book in a way that actually makes sense, not the fancy finance version, but the version that might actually help you not lose money. And yeah, we'll get to that mysterious Chapter 8. First, you need to know why Graham wrote this. Benjamin Graham was riding high. He was making serious money on Wall Street, managing investments, living the dream. Then the market crashed. The Great Depression hit. And Graham? He lost almost everything. But instead of walking away bitter, he did something different. He became obsessed with a question. Is there a way to invest that actually protects you when everything goes wrong? See, most investing books are written by people during good times, telling you how they got rich when everything was going up. Graham wrote this after getting punched in the face by the market, and that changes everything. He spent the next 20 years developing a method. Not to get rich quick, not to beat the market every year, but to not be stupid with money. And here's what he discovered. Wall Street was designed to make you act stupid. The whole system, the tips, the hot stocks, the daily news, the excitement, it's all built to make you confuse investing with something else entirely. Graham splits everyone into two categories, investors and speculators. Here's the difference, and it's simpler than you think. An investor buys a piece of a business and expects that business to generate profit over time. A speculator buys a piece of paper and hopes someone else will pay more for it later. Let me make this concrete. Say you buy shares of a company that makes $5 profit per share every year, and you pay $50 for it. You're thinking, in 10 years, they'll have made $50 in profit. I'll get dividends, the business will grow. That's investing. Now say you buy shares of a company that loses money, has no profit, but everyone's talking about it and the price keeps going up. You're thinking, this is going to $200, I just know it. That's speculating. Neither is necessarily bad. But here's the problem. Most people think they're investing when they're actually speculating. They buy stocks based on tips, trends, what went up yesterday, what some guru said on Twitter. Graham's first rule, know which game you're playing. And this is important because his whole system is built on a simple psychological truth. Markets are not rational. They're run by humans, and humans are emotional, panicky, greedy creatures. Which brings us to Graham's most brilliant idea. Imagine you own a small business with a partner named Mr. Market. Every single day, Mr. Market knocks on your door and offers to either buy your share or sell you his share at a specific price. Here's the thing about Mr. Market. He's completely insane. Some days, he's euphoric. This business is worth a fortune. I'll buy your half for $200,000. Other days, he's depressed. We're doomed. I'll sell you my half for $50,000. Same business, same profits, different mood. Now, you have 3 options every day. First, sell to him. Second, buy from him. Third, ignore him. The intelligent investor, they ignore Mr. Market most days. But when Mr. Market is severely depressed and offering prices that are obviously ridiculous, they buy. And when he's manic and offering crazy high prices, they might sell. This isn't a metaphor. This is literally the stock market. March 2020. COVID hits. Mr. Market has a complete meltdown. Amazing companies that sell products people actually need, drop 30, 40, 50%. Did the businesses change overnight? Mr. Market just panicked. The intelligent investors, they bought. Because they weren't listening to Mr. Market's mood. They were looking at the actual business. Graham's second rule, the market is there to serve you, not instruct you. But here's where it gets practical. How do you actually know when Mr. Market is being crazy? How do you know what a business is actually worth? This is the concept that changed everything for Graham. Think about engineers building a bridge. They calculate that the bridge needs to hold 10,000 pounds. Do they build it to hold exactly 10,000 pounds? No. They build it to hold 30,000 pounds. That extra 20,000 pounds, that's the margin of safety. Investing works the same way. Graham said, figure out what a business is actually worth, its intrinsic value. Then only buy it when the market price is significantly below that value. That gap is your margin of safety. Here's a simple version. Say you determine a company is worth $100 per share based on its assets, earnings, and future prospects. Graham would say, don't buy it at $100. Don't even buy it at $90. Wait until it's $60, $50, maybe even $40. Why? Because you might be wrong about the $100. The future might be worse than you thought. The economy might tank. Anything could happen. But if you buy at $60 and you're even close to right about $100, you'll probably be fine. You've got cushion, protection, a margin of safety. Now remember that chapter 8 I mentioned at the start? This is it. This is the chapter that almost got cut. The Mr. Market chapter. Graham's publisher said it was too theoretical. Give people formulas, Benjamin. Give them specific stocks to buy. But Graham insisted on keeping it because he understood something. The biggest investment danger isn't picking the wrong stock. It's your own psychology. It's letting Mr. Market's mood become your mood. Okay, so you get the philosophy, but what do you actually do? Graham splits investors into two types, and you need to pick one. The defensive investor. You have a job. You have a life. You don't want to spend hours researching companies. You want to invest intelligently but passively. Graham's advice for you. Split your money between stocks and bonds. He suggested 50-50, but anywhere from 25-75 to 75-25. 75/25 depending on age and comfort. Buy a diversified group of large established companies. Today, index funds make this easy. Rebalance once a year. Stop watching the market every day. That's it. Boring? Yes. Effective? Also, yes. The enterprising investor. You're willing to put in real work. And Graham means work, not watching CNBC, not reading headlines, but actually analyzing financial statements, studying industries, calculating valuations. If this is you, look for companies trading below their intrinsic value. Focus on companies with strong balance sheets, more assets than debt. Buy companies with consistent earnings history. Demand a significant margin of safety. Be patient. Good opportunities are rare. Here's the thing. Graham is brutally honest about. The enterprising approach doesn't necessarily make you more money than the defensive approach. It just gives you something to do if you're interested in this stuff. Most people should be defensive investors, but act like enterprising ones. They spend time and energy, but without the actual analysis. That's the worst combination. Pick a lane, stay in it. Now, this book was written in 1949. Some things have changed. What still works? The Mr. Market concept. Human psychology hasn't changed. Margin of safety. Still the best risk protection. The investor versus speculator distinction may be more relevant now. Not predicting the market, still impossible. What to ignore? His specific stock formulas. Markets are more efficient now. Some of his bond advice. Interest rates were different. His hatred of new companies. Some newer companies are fine, just be careful. The principles aged beautifully. The specific tactics, not all of them. Modern translation, buy broad index funds if you're defensive. If you're enterprising, focus on understanding business quality and only buying when there's a genuine margin of safety. Here's what Benjamin Graham figured out after losing everything in 1929. The way to build wealth isn't to be smart, it's to not be stupid. Don't buy things you don't understand. Don't follow the crowd when they're manic. Don't panic when everyone else panics. Don't confuse speculation with investing. 3 things to actually do after watching this. 1. Decide right now if you're a defensive or enterprising investor. Be honest. Most of you should be defensive, and that's perfectly fine. 2. The next time you want to buy a stock, ask yourself, am I buying this because I understand the business and the price offers a margin of safety? Or am I buying this because it's exciting and going up? Different games, different rules. 3. Stop checking your investments every day. Mr. Market is there, screaming prices at you, trying to make you do something. Remember, you don't have to listen. Warren Buffett once said that reading The Intelligent Investor was the luckiest moment of his life. Not because it taught him to pick stocks, because it taught him how to think about investing. You don't need to make $1 billion, but you probably don't want to be stupid with the money you have. Graham's book, it's the best guide to not being stupid. If you found this helpful, you know what to do. And if you want me to break down other classic investing books like this, let me know in the comments. See you in the next one.